The Federal Reserve plans to reduce interest rates earlier than expected, driven by a quicker decline in inflation and a softening job market. This signals a more aggressive approach to rate cuts than policymakers had previously projected. And to break all of this down is Josh Hurt, senior economist at Vanguard. Thanks for being here, Josh.
Thank you for having me.
So the Fed has cut interest rates by half a percentage point, an unusually large adjustment. And as mentioned, many are calling this aggressive. So can you break down this decision announced today and what it means?
Sure, yes. I mean, it was slightly larger than we were expecting. We were favoring a 25 basis point approach, but, it was a very close call. And frankly, we saw the merits of a slightly larger increase this time, too. And I think, as you mentioned, and as Chair Powell mentioned today, you have seen, substantial progress both in inflation and the labor market has cooled more substantially since the last meeting. So we saw it as a very close call, but yes, larger than expected.
So we really want you to give us the good, the bad, the ugly. What are some of the key takeaways from the FOMC? And did anything really surprise you other than the 50 BPS?
Right. So, I mean, there was really four things that, we were looking for today in the report and the press conference afterwards. Clearly, 25 versus 50 basis points was a really key question on a lot of investors' minds. So that was one thing. We certainly got that settled. But we were also very focused on what the statement of economic projections was going to show. So what the longer run path, both for what the Federal Reserve's intentions were this year as well as next year, were going to show. And I think in that case, broadly aligned with what we would have expected, a little bit more front loading in terms of rate cuts projected more so this year, a little bit less this year, by this time next year, signaling roughly 200 basis points lower in the interest rate, Fed funds rate. The other thing we're looking for was the statement. What were they going to signal in terms of how are they characterizing inflation, unemployment? What were some of the thresholds and the language used for what it would take for further interest rate cuts? Really nothing surprising there. They signaled largely the same, sort of tone in terms of the unemployment rate, signaling a little bit greater confidence in what has happened with inflation over the last few months. And they maintained a very data-dependent tone in terms of what it will take to see, future interest rate cuts going forward. The last thing was really just the market reaction. Really wanted to see how the market was processing, both the statement of economic projections as well as the 50 basis point move. Overall, it seems that the market is really processing this quite well, not any large moves in some of your broad measures today so far.
And we talk about how this is a positive reaction in the markets, but can you talk about, and maybe this question is better for Jerome Powell, but why do you think that it wasn't more clearly signaled ahead of time that it would be 50? And do you think this is possibly, to catch investors and consumers off guard a bit?
I don't think so. I think this was fairly well communicated. I mean, markets were generally pricing in a coin flip leading up to this weekend. There was some pretty clear, press communications late last week that I think really did set the tone for where we were. So I think overall, certainly on our team and some of the debates that we've had, this was a very close call, and there were some merits on both sides. So far, I think the challenges have been handled really well.
So, of course, we are in an election year. The election is coming up in November, and a big talker for a lot of people is the economy. So how might the Federal Reserve's larger interest rate cut impact the Biden administration as well as Vice President Kamala Harris's presidential campaign with this?
I wouldn't expect this to have a real material impact. You've seen, through time, the last few months that the economy is still doing quite well. In terms of the Fed's mandates, they are coming into better balance, and they're clearly taking action on that. The good news for the end consumer, for businesses, is you started to see some of this rate move already filter through into market pricing. The 10-year has moved over the last few months. We're seeing the 30-year mortgage rate has declined now below 6.5%. So you are seeing some of this already transmit through the economy even before today, but I wouldn't expect this to have a substantial impact on campaigns.
All right, and we talk, of course, a lot about inflation and economy here on Cheddar. So in your opinion, they talk about the cooling of inflation happening right now, but what is the biggest threat to our economy at the moment?
Well, clearly all eyes are on the labor market. This has been something we've been very closely watching, that the unemployment rate has risen a decent bit from its bottom, around the 3.5% rate early last year. So you have seen a rise there historically, once the labor market starts to soften, it continues to do so. So this is really where we're focusing on in the moment. But I also wouldn't take eyes off of inflation. The Fed's communication today essentially signaled that, inflation, the fight inflation is more or less over by projecting in their SEP. So some very positive numbers there. But it's something that's still elevated. And as we start to process the economy, I think it's really worth paying attention to that side of the mandate as well.
And continuing to speak about the economy, prior to the pandemic, more than 4 years ago, many people are hoping for a lot of the same things we saw maybe 2019 and before that. But with this current economy, the ebb and flow, is this simply the new normal and we should get used to it at this point?
Well, the economy is certainly very cyclical. I wouldn't expect, volatility to dissipate. We've actually done a lot of work around this, around elections, and we find that it actually does tend to dissipate a little bit before and right after elections, as as markets, as households, businesses really process new information, et cetera, around these events. But clearly, we would expect to see cyclicality be something that's maintained, and be very watchful of that, especially as we move into the next year. Today's really just the beginning of the easing cycle. In our view, there still would be a very long way to go in terms of the Fed really calibrating things appropriately. So still a lot to really keep an eye on.
And you also talked about keeping an eye on the job market. We know that the U.S. added 142,000 jobs in August, really falling short of expectations, while the unemployment rate dropped to 4.2%, as unemployment is expected to rise slightly. So you mentioned this, but I want you to talk more about it. How is the Fed balancing job growth and inflation? They're saying they see inflation cooling, but the job market is still a little strange out there at the moment.
Right. Well, the key thing is, to remember is that policy, does work itself through the economy with a time lag. So it does take time. Certainly the Fed is looking to be a bit forward-looking here. They're moving before inflation is, actually at 2%, but has been making substantial progress and appears to be on a trajectory that would keep it, close to 2% over the near term. And same thing with the labor market. We've definitely seen cooling. We've actually, on a 3-month basis, job creation has cooled, to roughly around 100,000. Certainly on the private side, we're just around at 100,000. So that's a number that I think, definitely caught our eye. Just a few months ago, you were really creating jobs at around 200,000 pace. So you've seen some slowing there, without question. And those are going to be the two areas to keep watching. And the Fed is trying to act in some ways preventatively, certainly from the labor market. Just from Chair Powell's comments, today's move is really meant to keep the labor market at a stable place. It's very uncertain where the actual sort of natural rate of unemployment might be at this moment. And so they're really trying to keep it in a range around the current levels, perhaps moderately higher.
And Josh, lastly, some investors really might interpret any rate cuts as a signal to possibly take risks right now, anticipating further cuts in the future, as was discussed. So how does the Fed plan to manage some of these expectations to prevent market overreactions to its decision made today?
That was a key area of focus for us. Would Chair Powell be able to really communicate, even with a larger move today, that there was still work to be done on both sides of the mandate? And I think so far his comments really did, do a decent job of communicating that. But I think, and certainly the statement of economic projections really forecasting the path ahead for the Fed did, a very good job of that. They don't appear to be moving too aggressively, but that's going to be something that they're going to have to keep on, because we know markets are forward-looking. They're really looking for any signs, to begin easing conditions even more substantially than was perhaps signaled today. So I'd say that there's still work to do on that, but I think so far from the initial comments in the press conference, that message has been communicated pretty well.
All right, we have to keep an eye on what happens next. Josh Hurt, senior economist at Vanguard. Thanks for joining us here on Cheddar.
Thank you.